Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets behind corporate filings, and today we're diving into Biodexa Pharmaceuticals, PLC's latest filings. This is where we see what is really going on under the hood beyond the press releases. This is an amendment to a registration statement, which means they are updating previous SEC filings. Think of it as a company's official update to the public about their business and financial health. We're looking at a company operating in the biopharmaceutical space focused on developing new treatments for various diseases. They're talking about things like familial adenomatous polyposis, bladder cancer, type 1 diabetes, and rare brain cancers. They've got a few key drugs in development and some interesting technologies too. One of their main focuses is a drug called Erapa, a special formulation of rapamycin. It is being developed for FAP and bladder cancer. They even received fast track designation from the FDA for Erapa, which is a big deal because it helps speed up the development and review of serious condition drugs. They're also working on tolimodone for type 1 diabetes and had studied MTX 110 for brain cancers, though that has been deprioritized for now due to money constraints. These technologies are focused on how they get drugs into the body, like sustained delivery or direct delivery to tumors. However, they mention that these technologies are no longer a key priority for them. This suggests a shift in strategy, focusing more on the actual drug treatments rather than the delivery methods. Now let's talk about money, because that is always a big part of these reports. As of late September, they had about £2.79 million in cash. This is an important number to keep an eye on for any company, especially one in a capital-intensive industry like biotech. It tells you how much runway they have to keep operating and developing their products. There have been some intriguing corporate actions, like a ratio change in their depositary shares. This basically means they changed how many ordinary shares each depositary share represents. They've done this a few times, often to manage their share price in relation to stock exchange requirements. It can be a bit confusing to track, but it is a common tool for companies, especially those dealing with price volatility. This filing concerns an offering of securities. They're looking to raise money by selling units, which are made up of an American depositary share or ADS, and a warrant. They're also offering what they call pre-funded units. These are mostly for investors who might end up owning too much of the company if they buy a regular unit. The price for these units is set at $5.09 based on their stock price at a specific time. They've hired Maxim Group LLC as their placement agent, essentially their salesperson for this offering. The payment structure is detailed, including a 7% cash fee on proceeds and other allowances. They're also giving the placement agent warrants to buy more shares. This is pretty standard for this kind of offering. Their stock is traded on the Nasdaq Capital Market under the ticker BDRX. This is where the public can buy and sell shares. The price has been around $5.04 recently. Now, every company filing includes a section on risks, and Biodexa's is quite extensive. They highlight the risk of their stock price declining due to the number of shares being offered. There is also the danger that their securities could be delisted from Nasdaq if their stock price falls too low. This is a serious concern for investors. They explicitly mention that the terms of their warrants could lead to significant dilution, meaning existing shareholders could own a smaller piece of the company. This is a recurring theme, the potential for dilution. It means that if the company needs more money in the future, they might sell more shares, which can reduce the value of existing shares. They emphasize that they don't currently plan to pay dividends, so investors are relying entirely on the stock price, increasing for any return on their investment. This is a crucial point. It is a best efforts offering, meaning the placement agent will try its best to sell the shares, but there is no guarantee how much they will sell. More importantly, there is no minimum amount they have to sell to close the deal. This means they might not raise the money they need for their business plans, which is a significant risk. Investors could also lose their entire investment if the company doesn't execute well. Looking at their financial health, their net tangible book value as of mid-2025 was about £5.79 million. This figure is essentially the company's physical assets minus its liabilities, divided by the number of shares. When they talk about dilution, they're comparing this book value to the offering price and showing how investors in this new offering might get more value per share than existing shareholders might see immediately. The as adjusted net tangible book value shows what that number would look like after this offering, and for existing shareholders it is a decrease. This is a classic case of dilution. The dilution section clearly illustrates the impact on existing shareholders. Their net tangible book value per share diminishes significantly after accounting for the new shares being offered. It is a stark reminder of how issuing new stock can affect the ownership percentage and per share value for current investors. Back to the business itself, they are a clinical stage biopharmaceutical company. This means they have products in development that are being tested in humans, but they are not yet approved for sale. Their strategy is to develop assets to a certain point, then find partners to handle the more expensive later stages of development, like late-stage human trials and marketing. The Arapa drug was licensed from Emtra Biosciences. As part of this deal, Biodexa paid Emtra with their own stock, giving Emtra a significant piece of the company, about 5% of outstanding shares. This shows how important this drug is to their strategy. As of the 1st of December, we see who the main owners are. A significant portion of shares are held by directors and senior management, which is common. And Merchant holds shares that are subject to stock options, meaning she could increase her ownership soon. Stephen Stamp, their CEO, also has options. Having insiders with vested interests can sometimes be a good sign. But it also means their personal financial outcomes are tied directly to the company's stock performance. They're offering units which are a package of one depository share and one warrant. The warrants give the holder the right to buy more shares later. These warrants have some unusual features like a zero cash exercise price option. This means that under certain conditions, people can get more shares without paying extra money. This is designed to heavily incentivize the warrant holder to exercise, even if the company doesn't get more cash from it. This can lead to massive dilution if many warrants are exercised this way. This zero cash exercise price option is quite notable. It makes it highly unlikely that anyone will pay cash to buy shares when they can get more shares for free under this option. This means the company likely won't raise much cash from these warrants. The warrants also have reset provisions where the exercise price can go down and the number of shares you can get can go up. If the stock price falls, this is a double. Edged sword, it might encourage exercise, but massively dilutes existing shareholders. The tax section is quite dense, covering both UK and US tax implications. For UK holders, dividends are subject to income tax, with different rates depending on your income bracket. For us holders, it gets complicated, especially if the company is considered a passive foreign investment company. Or FIC, this classification can lead to significantly higher taxes on gains and distributions. They state they don't expect to be a FIC, but it is something they have to check every year, so it is a risk. This section details how they plan to sell these securities. It is a reasonable best efforts offering, meaning the placement agent will try their best, but there is no guarantee of selling all the securities. Crucially, there is no minimum number of securities that must be sold for the offering to close. This means they could raise very little money, which ties back to the risk of not having enough capital. Finally, the exhibit index is where you find all the supporting documents like agreements and legal opinions. It gives a peek into the nitty-gritty details of their contracts and corporate structure. Now, let's talk about what I think of all this. Biodexa Pharmaceuticals is in a very tough, high-risk, high-reward industry. Their focus on developing drugs for unmet medical needs is commendable. However, the financial figures, like the limited cash on hand and the reliance on future funding, present a significant risk. The best efforts offering with no minimum commitment is a red flag for investors. It signals uncertainty about their ability to secure necessary capital. The dilutive nature of the warrants, especially with the zero cash exercise price option and reset provisions, is a major concern for existing shareholders. It's a strategy that can work by potentially getting drugs to market, but it comes at a steep cost to ownership value. The shift away from their drug delivery technologies towards a more focused therapeutic pipeline could be a smart move, but execution is key. The biggest opportunities lie in their drug candidates showing positive clinical results, especially Arapa. The risks are clear. Regulatory hurdles, competition, and the ever-present challenge of funding. Overall, Biodexa is a speculative investment. They have promising science but face significant financial and execution risks. Investors need to be comfortable with a high degree of uncertainty and potential for significant dilution. That is our take on Biodexa Pharmaceuticals filings. What are your thoughts on their strategy, especially regarding those warrants in the funding situation? Let us know in the comments below. If you found this deep dive useful, hit that like button and subscribe for more corporate breakdowns. And don't forget to join our Discord community for more discussions and insights. The link is in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.